good afternoon, and thanks for taking the time to hear about smaller companies. And I'm afraid I'm going to subject you to a little bit of a corporate video here. So over to the screen for a minute or two.
Why should investors look at smaller companies? Because smaller companies are too big to ignore. They present a vast opportunity. There's a huge global equity universe, but the galaxy of smaller stars is both large and diverse. Imagine the potential opportunities waiting to be discovered in companies across entire continents, sectors, and industries. This is an age of rapid acceleration. The pace of change has never been so fast. Traditional business models are being shaken up, and the smaller, agile, innovative firms are playing their part in the disrupting. History also tells us that smaller companies have outperformed large ones over the long term. $1 invested in US smaller companies grew more than 6 times than $1 invested in US larger companies between 1926 and 2017. Worldwide, since the year 2000, smaller companies have outpaced larger ones by an average of 5% a year. This is a return premium that long-term investors strive for. Yes, the risk can be higher, but risk has many dimensions. Understanding the different elements of risk and how they are priced into the share price is key to uncovering value. It's not just about company size, it's about country, sector, company fundamentals, and industry exposures. Investors can profit by tilting their portfolio towards styles such as quality, and most importantly, identify specific opportunities. Smaller companies are such a big part of the investment universe, but are often less understood. On average, 23 analysts cover each larger company, compared to 7 for a smaller company, resulting in a greater chance of a stock not reflecting its true value. This makes active managers more likely to succeed, hunting, analyzing, and identifying the opportunities that can be missed by the market, but offer potential for long-term returns. There are more than 6,000 stocks in the global investment universe. Can you see which ones will be the larger companies of tomorrow? We believe we can.
Okay, well, thank you very much for listening to that. I've been manager of the Aberdeen UK Smaller Companies Growth Trust since 2003. And actually, we run an open-ended version of this, which has been around since January 97, and I launched this one as well. Moving on to our team. This is our current team, and we've been together for some time now. Led off by Andrew Paisley. I run the Aberdeen Smaller Companies Trust with Abby Glennie, and we are co-managers. And the third person in what we call the UK pod here is Amanda Yeaman. We have quantitative analysts in Laura Odekanaku, and we also have an environmental, social, and governance specialist in Juliana Levrenti. And you can see the extraordinarily international nature of our team. And we like to feel that we are the leading smaller company investor in the UK. We run UK small and mid, we run European smaller companies funds, and we run global small and mid-cap funds. And in this area, we have around about £8 billion across those sizes and categories. What is a smaller company, though? In UK terms, you can see the market as being 2.77 trillion. And I believe the largest company at the moment is AstraZeneca, which actually has a value of about 6 or 7% of the whole market. So it's nearly as big as the entire smaller companies universe put together. So we're interested in this bottom 10% of the market by value. It's 10% of the value, but it's the vast majority of the company. And you can add on the alternative investment market on the other side. So about a third of our universe is in the AIM market, which actually we found is a much more respectable place to invest in the last few years. We've had great success investing in AIM stocks as well. And roughly a third of our holdings are in AIM stocks, the other 2/3 obviously in the bottom 10%. So there's only about 170 companies in the whole UK market that are too big to be in the smaller companies segment, the bottom 10% of the market. And don't get slightly confused. The FTSE series of indices is slightly different. The FTSE mid-cap index, the 250, actually straddles smaller companies. About 2/3 of the mid 250 is in the Numis Smaller Companies Index plus AIM, which is our benchmark. Just a quick look at returns. Professors Dimson and Marsh of the London Business School have been studying the returns for many, many years. They launched the Numis Smaller Companies Index. It was called the Horgevet Index in those days, back in 1987. And they back-tested it back to 1955. And the returns, that red bar should be here. This is the area we're looking at. These are the absolute tiddlers, even better performance. But the smaller company market, 10,000, £1 has become 10,138 pounds since 1995. And clearly much better than larger companies and much better than bonds and other assets. Now, another way of looking at it is the annualized return, real return, UK assets in 1955. Clearly, the Numis Smaller Companies Index, 9.7 against the Numis All Share, and then you got long gilts. You might think house prices have done splendidly well for you, but actually returns have been far poorer than smaller companies or any sort of equity investment for that matter. You can look at returns in another way. This is long-term performance, size-based indices, and then actually when you reinvest the dividends, you get significantly higher returns. So what have we got in smaller companies? These are companies actually that can make 10, 20, even 50 million pounds of profits. They're not your joiner around the corner or something like that. They may have hundreds or even thousands of employees. And a number of these companies you will have heard of. For instance, Jet2 Airlines, which is actually still its founder-run business. Marshalls, the UK's largest block paving company, 60% of the market. Motorpoint, I'm not sure if any of you buying used cars, but they are the UK's largest used car company. And you might have heard a lot of noise from the likes of Kazoo and Cinch recently. Now, these are companies that are suddenly appeared on the scene. Now, they make hundreds of millions of pounds worth of losses. Motorpoint can deliver a car to your door, and it makes 20, 30 million pounds worth of profit. I'd rather be in Motorpoint. Telecom Plus, that's an interesting one. I don't know if any of you buy your gas, electricity, broadband, phone, mobile, landline from Utility Warehouse, which is their brand. It's an alternative supplier of these things. You can buy all these things from the one company. But note that all the other alternative suppliers of gas and electricity have pretty much gone bust in the last 2 years. Utility Warehouse, Telecom Plus is set to benefit from that. You've heard of AJ Bell. So these are UK leaders. We've also got global leaders in small niches. I don't know, for instance, are there any Led Zeppelin fans in the audience? Please raise your hands if you're a Led Zeppelin fan. Thank you. Loads. I thought it was generally the right demography here. Its chairman actually is Phil Dudderidge, who was the chief sound engineer for Led Zeppelin back in the day. But their business now is in, I'm too old to fully understand what they do, but I've got loads of younger colleagues that do techno music. So it's all the sound. You can set up, make your own music. You can make your own podcasts, all the music, the sound that goes into them. They're a world leader in that market. You might have heard of Games Workshop. I don't know, this is a slightly different demographic, but any Warhammer fans in the room? Anybody admit to being a Warhammer fan? I've got a couple. That's fantastic. Okay, well, this is a company that actually makes, I don't know, you might want to close your ears here, but they make roughly 180 million pounds of profit off 370 million of sales last year. It is a phenomenally successful business. It's a small niche, but they're all around the world. Smaller companies can make it big all around the world. The same goes for Watches of Switzerland. That's an interesting one, listed 2 or 3 years ago. Swiss watches in the UK, but increasingly in the US. It's not all about fancy Apple watches. People like to show their wealth and success through their Swiss watch. It's run by a guy called Brian Duffy, who comes from, is anybody here from Glasgow? Anybody from Glasgow? No? Well, that's a shame, because you will have heard of Castle Milk. It's the roughest housing scheme in Glasgow. Brian Duffy comes from there. He's the chief executive of Watches of Switzerland, and they are phenomenally successful. So this is our investment process. Quality, growth, and momentum is what we're all about. It's a risky area, smaller companies, and so it pays to invest in quality businesses that can get through the hard times. So quality is important. What do we mean by quality? It's balance sheet, it's cash flow, it's visibility of growth and earnings. Sustainable growth. Well, we touched on growth. That's important to us. We like to run our winners and cut our losers. We like stocks that are getting better, and we use earnings revisions momentum specifically for that, which we can talk about. That's a whole subject in its own right. If anybody wants to talk about that later on, we can. We invest for the long term. We run large funds, so we can't trade in and out of stocks. We have to just buy great companies that are getting better, and that's the key, that are changing for the better, and get rid of all the companies that are getting worse, just companies that are getting better, and hold them for the long term. So our holding period is generally about 5 years, so at 20% turnover. We really hang on to these great companies. Management quality, as a hint on that, we do like founder-run businesses, and I would say about a third of our companies are still run by their founders, and they are special people that can take a company from nothing to be making tens of million pounds worth of profit. We like low staff turnover, particularly at a senior level. That's very important. And we look at things like Glassdoor and Net Promoter Scores, Trustpilot and the like. What does the public think of these companies and how they're run? And for instance, that company Jet2, I mentioned the airline. They're not big in London, although they operate out of Stansted, I noticed. But they are actually, according to TripAdvisor, the 8th most favorite airline in the world. The 8th most favorite airline in the world. There's no other British airline, or Irish airline for that matter, in the top 100. That's how good they are. And their Net Promoter Scores, their Glassdoor scores, this is what people say about, the employees say about the business, and Trustpilot say that they are a great business. We're valuation aware, but it doesn't drive our process. Now, I'm conscious of time. I don't want to get told to shut up, because I've got a lot to tell you. These are some of the things we avoid. We avoid blue sky companies, highly leveraged businesses, highly cyclical companies, and we avoid deteriorating matrix scores, earnings downgrades, and the like. This is our performance since 2003. 1,173% return over that period for the shares. The net asset value slightly less, because the trust was at a very heavy discount when we took it on, but much more than our benchmark and much more than the FTSE 100, 79% returns. So this is converted into 14.8% compound annual growth rate every year, against 4% better than the reference index. Now, I should point out that you have to be able to handle risk and volatility at investors, because there have been several times, and I'll come on to this, where our fund has been down a lot. So you have to be able to cope with that as investors. This is our top 10. Some of these names will be familiar to you, but you'll see we don't go above 5% in an individual holding. You might have heard of SafeStore, the self-storage business. It's the UK's leading self-storage company. It's bigger than Big Yellow. But it also is expanding outside the UK. It's got businesses in Madrid, Barcelona, in Benelux as well. And just remember, quite often the US leads. There's far more self-storage in the US. Then comes the UK, and Europe are way behind. They hardly know about self-storage. They don't get involved in that. So you'll have heard of some of these names. But the point I'm making here is that markets have been really weak lately. But 7 out of our top 10 stocks are showing earnings forecasts upgrades. The sell-side analysts that cover these stocks are raising their numbers. So the majority of these companies are getting better right now. They've also, the dividend, look at the dividend growth for these companies. There's a lot of recovery. You'll have heard of all the dividend cuts that have been in the last 2 years of COVID. Well, they're coming right back up to where they were before, and they'll go beyond. And that is shown by the forecast. This is a forecast, earnings per share growth that we're seeing for 2022. These companies are growing quite quickly, and they will beat their numbers because the majority of them display this earnings momentum. These are the valuations. I don't know who's a price-earnings ratio sort of a person. These might look a little bit expensive to you, but you get what you pay for quite often in investments. They're expensive because they're better companies. And actually, because their earnings forecasts are going up, the E part of the equation is getting better. Okay? Now, we're on to market timing, because I'm sure you're all familiar that markets have fallen pretty sharply in the last few months, and our trust is no exception. So this is the 5-year returns from our trust. Price of oil. Price of oil is very topical at the moment. What I'm trying to show here is, if it stays there for any length of time, the 5-year returns from our trust since we launched it in, it was 2003 was when the trust, we took over the management contract. And you can see that generally these returns have been between about 50, let's say, and 150%. Now, there's this spike here in 2013 up to 250%. So that was 5 years after the banking crisis, 2008-09. So clearly the message here is that times of very weak stock markets are when you have to be ready to invest, because you can make outsized returns over the next 5 years. That is the message there. So what I thought would be interesting was to look over the FTSE 250 index. This is mid-caps, and they're very like small caps, and indeed 2/3 of them are small companies. 250 index since 1985, when it was launched. And this is just the progression of the market. And what I've had a look at is each fall in the market of more than 20% are described as a bear market, a falling market. How long did they last? Well, 1987, it was 1 month. 2000, it was 28 months. And you can see the amounts that the markets fell during those periods. Up to 50% in 2007 to 9, 41% twice. You've got to be able to live with that if you're investing in smaller companies. But the flip side is, how long after the bottom did it take to reach a new high? Okay? Generally speaking, under 2 years. Under 2 years, you'd already gained back all this territory. You can see it in 01, 03, up here. Banking crisis, up there. COVID. In COVID, the share price of the trust fell by 50%. Where you can see that I've even looked at the FTSE All Share. You remember, lots of you are old enough to have been around in 72 to 74. Markets fell by 70%. 33 months, new high. So I think you're very shrewd coming along to the investor conference day and really learning up about investments at this moment, because the time over the next few months, be aware there could be a good time. So next slide, please. Okay, I'm just comparing it with our own trust, and we're down 28% since September here. That's there. I think it's time to pay attention. And finally, so better returns for smaller companies for the long-term investor, but remember, it's risky and it's volatile. You have to be able to cope with that. And 5-year investing is what you should think about. If you can cope with that, then it's worth looking at for part of your investment portfolios. So be alert for the buying opportunity.